G'day legends, and welcome back to the channel that keeps your portfolio hopping gold jumper. Jump up and under, let's get into it. Today we are breaking down the absolute madness in the markets from March 25th to March 27th, 2026. We are looking at the massive gold correction, the surging oil prices from the Middle East conflict, and a deep dive into the magnificent 7 tech stocks. We will also wrap up with a full technical analysis of gold and the latest sentiment from the traders over at Wall Street Bets. Before we start, a quick disclaimer. This is for entertainment and info only, not financial advice, so do your own research. Now, the big question for today is, with gold currently testing major support, is this the end of the bull run or just a massive trap? Let us know your thoughts in the comments, and if you find this helpful, smash that like button and subscribe for more legends. Let us kick off with the biggest geopolitical story, the escalation of Operation Midnight Hammer in the Middle East. The Strait of Hormuz is effectively a no-go zone right now, with maritime insurance basically non-existent for international shipping. Iran has set up a vetting system for friendly ships, but everyone else is facing sea mines and drone threats. This is a massive supply shock, with 20% of the world's oil and natural gas stuck behind a strategic choke point. President Trump has been busy on social media, claiming that Iran is begging to make a deal while sending 2,000 to 1,000 more troops. However, on Friday, March 27th, some relief hit the news as Trump extended a deadline for Iran to secure a ceasefire. He pledged to hold off on targeting Iranian energy facilities until April 6th, which gave the markets a tiny bit of breathing room. Iran even allowed 10 oil tankers through the Strait this week as a supposed present to the United States. But don't get too comfy, because the Iranians officially rejected the US 15-point peace plan just a day ago. This geopolitical tug-of-war has sent the crude oil volatility index, or OVX, absolutely through the roof. Usually, the OVX sits between 25 and 35, but right now it is screaming above 90. That means traders are expecting daily oil price swings of 3 to 4%, which is enough to make any trader sweat. West Texas Intermediate Oil, or WTI, closed up nearly 5% on Thursday to $94.48. That is a massive jump from the mid-$60 range we saw back in February before the fireworks started. Every 10% rise in oil is like a tax on the global economy, hitting the GDP by about 15 basis points. Back home in Australia, the latest inflation data for February 2026 just dropped on March 25th. The Consumer Price Index, or CPI, came in at 3.7%, which is slightly down from the month before. Housing costs are the biggest pain point for us Aussies, up 7.2% over the last year. The Reserve Bank of Australia is warning that the economy is further from balance than they previously thought. They are signalling that interest rates might have to stay higher for longer to get that inflation back into the pouch. Unemployment is holding steady at 4.1%, but the RBA expects it to tick up by the end of the year. Our manufacturing sector is finally showing some life, but these high fuel costs might kick it back down in the next quarter. Meanwhile, over in the US, the Federal Reserve held interest rates steady at 3.5 to 3.7 to 5%. But the tone was hawkish, with the Fed signaling only one rate cut for the entirety of 2026. This is a huge shift from earlier this year when everyone was betting on a series of cuts to boost the markets. The energy shock is making the Fed's job a nightmare, as they cannot cut rates while oil is fanning the inflation flames. Now, let's look at the Aussie dollar, which has been a bit of a roller coaster. On March 25th, the Aussie dollar was trading around 0.7073, but faced heavy resistance. By Friday, March 27th, it was hovering around 0.6893 as the greenback flexed its muscles. When the US dollar index, or DXY, hits 99.9, it puts a massive lid on our local currency. The ASX 200 has been sliding dangerously toward a bear market as resources and banks take a hit. While the ASX futures saw a brief bounce earlier in the week, the overall trend has been quite grisly. Compare that to the S&P 500, which has dropped about 4% since the war in Iran kicked off. The S&P 500 is now struggling below its 200-day moving average for the first time in nearly a year. It is a tough time for the indices, as the magnificent 7 tech giants are finally starting to splinter. Let's do a deep dive into these tech titans, because the halo effect is officially wearing off. In March 2026, we are seeing a massive, great valuation rotation away from mega-cap tech. Microsoft has been the biggest loser of the month, down nearly 20% year-to-date. Investors are getting nervous that the massive spending on AI isn't going to pay off fast enough for Microsoft. Tesla is also in the wars, down 14.6% as electric vehicle demand continues to soften. Amazon is down nearly 10% as the market loses patience with their high AI capital expenditures. Apple has dropped 8% this month due to ongoing concerns about global consumer demand. Meta Platforms fell 7.8%, with a big 7% drop just on Thursday alone. Meta is dealing with a nasty combo of legal setbacks and fresh layoffs that have investors jumping ship. Nvidia is actually holding up the best, only down about 4% for the month of March. It seems Nvidia is still the king of the AI infrastructure hill, but even the king is feeling the pressure. Alphabet is also relatively resilient, down only 2.3% as their ad business stays strong. But here is the real kicker. Insiders at these 7 companies have sold $8.4 billion worth of stock recently. When the bosses are selling in droves and not buying a single share back, that is a massive red flag for us traders. Only Elon Musk at Tesla has been buying, but the rest of the gang seems to think the top might be in. Now, let's talk about the big guy, gold, and what the famous investors are saying about this recent crash. Jim Cramer from Mad Money has been out there criticizing gold as a crisis hedge during this Iran conflict. Cramer says gold is failing because over-leveraged traders are forced to sell it to cover their losses elsewhere. He calls it a liquidity event, where people sell what they can, not what they want to meet margin calls. On the other hand, veteran strategist Ed Yardeni is still pounding the table with a $6,000 target for gold. Yardeni thinks this is just a correction, and that de-dollarization will eventually drive gold to 10 to 1,000 by 2030. Ray Dalio is also staying firm, suggesting a 10 to 15% gold allocation as essential portfolio insurance. Over on Wall Street Bets, the mood is pretty salty, with many calling this the most brutal metals crash ever. Some users are memeing about Liberation Day 2.0, hoping for a massive bounce like we saw last April. They are telling everyone to buy the dip because they think the market is just overreacting to the war headlines. But there is also a lot of talk about a coming recession as big tech starts trimming the fat with layoffs. De-dollarization is another hot topic, with BRICS nations moving toward resource-backed trade to bypass the US dollar. Saudi Arabia ending the petrodollar agreement has been a massive catalyst for this shift in global reserves. Central banks are still buying about 60 tons of gold per month, which provides a long-term floor for the price. Now, let's get into the nitty-gritty of the gold price action for the last 3 days. On Wednesday, March 25th, gold actually climbed back above $4,500 on peace hopes. But that rally was short-lived as the heavy reality of higher for longer interest rates set back in. On Thursday, March 26th, gold prices tanked nearly 3%, dropping toward $4,460. By Friday, March 27th, spot gold has stabilized slightly around the $4,390 mark. This is a huge drop from the all-time high of $5,589 we saw back in late January. Silver hasn't fared any better, dropping over 23% in the last month as the metals sector resets. Copper is also down about 7% this month, signaling that global growth might be hitting a brick wall. Alright traders, it is time for the technical analysis deep dive, so pay close attention to these levels. The gold price is currently stuck in a descending channel that has been in place since early March. Our main resistance level to watch is $4,600, which has rejected every bounce so far. If we can't close above $4,600, the bears are going to keep the upper hand in the short term. The next major support floor is sitting right at $4,311. That level is the 61.8% Fibonacci retracement from our recent cycle low. If that floor breaks, we could be looking at a trip down to the 200-day EMA at 4,200. Now let's check the indicators. The Relative Strength Index, or RSI, on the daily chart is at 40.4. That is a sell signal, showing that the momentum is still firmly with the bears for now. On the 4-hour chart, the RSI is at 43.2, which is also looking pretty weak. The MACD is currently negative at 0.3 to 6, reinforcing that the trend is downward. We are also trading well below the 50-day moving average of 4,967. In fact, gold has stayed below its 5-day, 20-day, and 50-day averages for over a week now. The Bollinger Bands are widening, which usually means more volatility is coming our way very soon. We are also on the lookout for a death cross, where the 50-day average crosses below the 100-day. The 100-day moving average is currently at 4,636, so keep an eye on that. For the bulls, the Eagle indicator is showing a slight positive divergence, which might hint at a bottom forming. But until we break that 4,600 resistance, it is all just noise in the wind. Don't sweat the dip, just more room in the pouch, as long as you manage your risk properly, legends. The Fibonacci pivot point for gold today is 4,362, so we are right in the zone. If we hold above the pivot, we might see a test of 4,452 by the end of the day. But if we slip below, the 6/8 Murray math level at 4,375 is the next target. Looking at the 1-hour chart, gold is forming what looks like a bearish, rising wedge pattern. This often leads to another leg down, so don't be surprised if we see a flash drop before the week is out. The average volume has been ticking up during the selling, which shows institutional conviction in the move. However, central bank buying remains the invisible flaw that prevents a total collapse of the gold market. JP Morgan still thinks gold will hit 6,300 by the end of the year, so don't lose heart. They believe the current volatility is just a healthy shakeout of the weak hands and speculative froth. Deutsche Bank and Societe Generale are also staying bullish with $6,000 year-end targets. They are betting that once the oil shock settles, the focus will shift back to US debt and fiscal deficits. And as we know, gold loves a good deficit story more than a kangaroo loves a grassy plain. The structural case for gold, de-dollarization, and central bank demand has not changed one bit. We are just dealing with a massive macro headwind from a stronger US dollar and rising treasury yields. The 10-year bond yield is at 4.136%, making it a tough competitor for non-yielding gold. To summarize, gold is under pressure due to high oil, a hawkish Fed, and a strong US dollar. Tech stocks are cracking, especially Microsoft and Tesla, as the market rotates into more defensive value. The Strait of Hormuz conflict is the main driver of volatility, keeping the OVX at extreme levels. WTI oil is hovering in the mid-90s, and that is keeping inflation concerns at the front of everyone's mind. Australia's inflation is sticky, and the RBA isn't planning on cutting rates anytime soon. Technically, gold needs to break 4,600 to turn the tide, but for now, it is a strong sell. Support at 4,311 is the line in the sand for the long-term bull market. So, what's your play, legends? Are we heading to 4,000, or is the recovery starting on Monday? Smash that like button if you enjoyed the update, and make sure you're subscribed to Gold Jumper. Drop your price predictions for next week in the comments below. I read every single one of them. Stay active, stay legendary. Catch ya.